We'll give it a couple seconds for people to start joining if they want to. Hello, hello. Hello. Okay. So we are back for Mega Money Mondays. Yes, ladies, let's go. Hello, hello. Mega Money Mondays are where I go live in my free Facebook group. If you're not a part of it right now, it is called Master Your Money and Build a Bank Account That Never Stops Growing. I am only going live on Instagram right now as a way to kind of promote the group. So eventually I will not be going live on Instagram answering your questions. So if you have questions for me, I do free coaching. Get your butt into the free group. Okay. Now, what I want to do is, people have been sending me questions, they've been DMing me, they've been sending me questions in the Facebook group, and I want to go over them and I want to answer their questions first. If anybody else has a question while I'm on here right now, feel free to type it in, and I will go back and answer all of those questions. So let's get started. The first question is, hi Nicole, I'm 20 years old and I would really like to get started on the best ways to save money. Should I put money in a savings account every week, or should I be taking the cash out and saving it somewhere physically? Planning on paying off some credit card debt and buying a car. First of all, yay, congratulations. I love seeing young women who are going out there and getting their goals, like starting when you're 20, man, like you have time on your freaking side, so let's go. So let's get into this question. So what are the best ways to save money? She said that she's asking about, putting money into a savings account every week, or taking the cash out and putting it somewhere physically. She wants to use that cash to pay off credit card debt and buy a car. So those are great, great questions. When we talk about saving, I'm never going to tell you to take your cash out and hide it under your mattress. So that is number one. I've talked about it a bunch of times, but I will go through it very quickly. When your money is just sitting in a bank account, or when your money is sitting under your mattress or wherever else it is physically losing value because of inflation. Inflation is when the general cost of items and goods and shit that we purchase is more expensive every year. So I remember I was talking to my parents over the weekend and they were like, I remember when a Toyota Corolla was like $5,000 or whatever the fuck the car was. And it's like, now it's like 30 grand or 50 grand or 60 grand, right? And this is because of inflation. So what we have today, if we have money today that is not growing and we just have it hidden under our mattress or sitting in a bank account, not making any interest, it's physically losing value. You will be able to buy less and less things with that money over time. So first and foremost, you want to make sure at the very minimum that your savings are in a high interest savings account. The best places to get a high interest savings account are going to be probably through online banks. Online banks are really great for this because they don't have as much physical overhead. So they don't have overhead for like bank tellers and real estate and all of that kind of stuff. So because they don't have as many expenses, they are actually able to pass more savings along to you in terms of higher interest rates, lower fees, right? There are a ton of really great banks. Mine in Canada is EQ Bank. I love them. It is amazing. You can go on there and you set it up in literally 5 minutes. And you can go through and you can create as many accounts as you want. Now you still have to have like a physical bank account as well because they don't have like debit cards or anything like that. But for your savings goals, for your like emergency fund or immediate savings goals, it is a really, really, really great opportunity. So when we're talking about, she wants to pay off some credit card debt and she wants to buy a car. I don't think, if she's saying that she wants to put this money away and save it up and then pay off the credit card debt, I don't think that that's something that I would recommend. Because which Canadian bank? EQ Bank. You can look them up online. Tangerine is also a really great option as well. Again, so I don't recommend saving up to put money onto your credit card. The reason being is the interest that you're going to get from a high interest savings account, or even if you invested, is not going to be anywhere close to what you're paying on your credit card. Your credit card interest rate is probably, I don't know, like 19%, 15%, 22%. Like you are not getting that kind of return anywhere, and it's kind of predatory when we think of it like that, but that means we want to put as much money there as possible. Before we start investing, before we start doing anything else, we need to pay down that high interest debt, because if we don't, it is going to keep us in a vicious cycle. Okay, so first and foremost, put all that money, don't save it, girl, put it on your credit card. And when we're talking about saving for buying a car, we want to think about how long this goal is. So we want to know our timeline, our goal, and our tolerance for risk, or our investor profile. And when we're talking about that, if we're looking at investing like in the markets or something like that with stocks or bonds or ETFs, you don't want to put your money into that stuff if you need it within 5 years. So I always say like a 4 to 5 year timeline in order for, because the markets are going to go up and down every day, right? Like last week they were dropping, this week they're up. They're going to go up and down every day. And the way that you win with the market is not trying to time the market, it's by spending time in the market. The longer you spend, the longer you have until you need that money, typically the safer you are. So if she's thinking about buying a car, I don't know how far away this is, maybe it's a year or two. In terms of where you can put that money, you can open up a bank account, like I said. Yes, I am in Canada. You can open a bank account, like I said, at like EQ Bank. You can go in, and I think this is like the best thing ever. You can go and you can name your accounts. So instead of being like, okay, I'm putting this money in a savings account or whatever, and like, you know, you go, you open your app, and you're like, I really want to buy that sweater. I really want to go for dinner, and like, I'm just going to transfer some money over into my checkings account. If your bank account, if your savings account is literally named my car or trip to Italy or my first house or whatever the fuck it is, that is so much more powerful. It feels so much better when you start to see that balance grow. You're like, yes, look at me go, right? I am getting closer to that goal. It also makes it more difficult to take money out of there. Another pro tip on this is to separate out your savings account and your checkings account. So have them at two separate banks so that it's not so easy to just transfer funds over. Maybe you have to wait a couple business days, and it makes it a lot better for you because you don't have that temptation of just taking it and spending it right now. I'm going to jump onto here with a question. I've paid off $35,000 of debt this year. Yes! Go you! I love that. Congratulations. Okay, the only debt I have left is a vehicle, which I can easily afford the payments on. Should I start investing or pay off the vehicle first as quickly as I can? Okay, so typically what you want to do here, so this is like the standard kind of money answer, okay? What you want to do is look at your interest rate. So you say, okay, I have my interest rate for my car, and maybe I'm paying 2.49%, okay? And then I have the interest rate that I can get in the markets with investing. Maybe you can get 6%, 8%, 10%, whatever it is. It depends on what you're invested in, your tolerance to risk, all of that kind of stuff. But for, example's sake, let's say 8%. So you got a 2.49% interest rate on your car loan, and you can make 8% investing that money into the markets. Financially, it makes more sense to put that money into the market. That said, you have to do what's best for you personally. If you would feel more comfortable paying off your car, then you need to do that. If it's going to make you happier, if you're going to feel less stressed, then that's what you need to do. Do you know what banks would give high interest for your money in Australia? No, honey, I'm sorry. I don't know off the top of my head, but I would just do a quick Google search, high yield savings account in Australia, and a bunch will come up. My son is 1. Should I put that away for college in a 529, or should I put that money into an investments and then pull it out if and when he goes to college? So I'm not entirely sure what that specific account is for. I'm assuming it's an education savings account. I don't know the specifics behind it, but I know in Canada we have an RESP, which is a registered education savings plan, and the government gives you money. I think it's like $500 for every $2,000 you put in a year. It's free money. So if that account is going to give you free money and then you invest it through that account, which is typically how it goes, then I would say that's a great idea, right? You don't need to put it in a separate account. And if you have somebody that is offering you free money, if the government is offering you free money, if, I don't know, whatever, your employer is offering like a 401k match or an RRSP match, take all the free money you can get, okay? I want to start thinking about an IRA and a Roth IRA as a 23-year-old, which is better. It's really not dependent on your age. The difference between an IRA and a Roth IRA are going to be when you pay the taxes. An IRA is you're not paying tax now, so you say you put in $6,000 to your IRA, you get to technically write off that $6,000 from your taxes. So say you made $50,000, then you would write $6,000 off of that, okay, to $44,000, and then $44,000 is what you're paying taxes on. So you're getting tax savings today. What you want to do is take those tax savings and put it in right? Reinvest it. So you're reinvesting that money and it is growing for you. A Roth IRA, you're paying taxes on the money right now, but all of your growth is tax-free. So there are some really great calculators online. I would say go check those out. Typically, if you're in a higher tax bracket now than what you will be when you retire, the standard or a traditional IRA could be better. But it really depends on your tax rate. So I would say check out some online calculators for that. If you have a 100K investment account and you're trying to compound interest, what is the best way to do that? You need to invest your money to be able to get the interest compounding. So I'm not really sure like what is the best way to do that. You invest your money based on your goals, your timeline, and your tolerance to risk, right? So you need to figure out what those are, and then you make your investments based on that. Do you have to pay taxes on money from the government in the RESP? It's not like a tax sheltered account in the sense that like you're not getting a tax write-off from that money, but the growth is tax-free. I just opened a self-directed TFSA. Which index funds would you recommend? Also, I would like to invest into more than one, or also would you invest into more than one, like an S&P 500 index and then some other international index? So typically, yes, you want to invest in, you know, maybe 3 to 6 ETFs, and you don't want to have a lot of overlap between them, right? You want to have them in different areas. So maybe you invest in one that's in the US, maybe you invest in an ETF that tracks companies in Canada, one that tracks companies in Europe, one that tracks companies in Asia, one that, you know, tracks bonds, like a bond ETF, right? And you can create your own portfolio that way. I go through all of this in more detail in the Millionaire Investor Self-Study Program. So if you guys are interested in that, you can use code Millionaire100 for $100 off. The link is in my bio on TikTok and on Instagram. So if you guys have any questions about that too, you can pop them in here and I can answer that while I am here. When it comes to, you know, what you want to invest in, it really depends again on your goals, your timeline, and your tolerance to risk. There is no one portfolio that is just good for everyone. But I go through in the course how to decide exactly what you could be investing in, and it's super, super simple, right? You can go into just one, right? There are things called asset allocated funds, which is an entire portfolio all in one, and you can choose them based on your risk tolerance, right? They'll have a higher proportion of stocks or a higher proportion of bonds. So highly recommend the Millionaire Investor course if you guys want to know more about investing for your personal situation, because it's impossible for me to give personalized investing advice over, you know, Instagram, because I don't know your situation, right? Would you recommend paying off low interest debt before saving for a down payment? It really depends. It really depends. So for me, I paid off my student loans after I bought my property. The reason being is properties in my area were going up like 20% year over year. And I knew that if I didn't jump in soon, I was gonna get priced out of what I was comfortable spending in the market. So you really need to look at what's happening in the housing market right now. Are housing prices going up? Am I at a point where I'm close to being priced out for what I can afford or what I want? And what's more important to me personally. And if you go to buy a house, you know, and you still have the car payment and you still have the student loans, are you going to be comfortable paying that mortgage and also paying those other bills? And also you need to remember that you're going to qualify for a lower mortgage amount when you have those student loan payments and when you have those car payments as well. Do you recommend any apps? Stacy, I'm not sure what you mean by that. Let me know apps for what, and I can come back to it. Okay, so I'm gonna get back to the questions that I've had over the last week. I've taken steps to open a Wealthsimple portfolio. I'm in Canada. I want to invest in a few more ETFs, so I'm wondering if it would make sense to close my TFSA portfolio and invest in individual ETFs, or both, or just through a TFSA on the Wealthsimple Trade app. First and foremost, when you are looking at investing, you want to be trying to, okay, so let's go back a minute. There are two things that are certain in life, and that is death and taxes, okay? You will always have both of these, and taxes can be a friggin' bitch, okay? They're super, my husband just joined, sorry, I got all, okay, so two things that are certain in life, death in taxes. So what you really want to do is make sure that you are limiting your tax liability as much as you can. So taking your money out of your TFSA and going into just a regular portfolio, which for you guys watching is basically just like a bank account that you invest through, it gives you no tax benefits. All of the money that you make will be taxed as income when you sell those assets. So that's something to remember. So no, I wouldn't say to take your money out of your TFSA for investing. I don't think that that makes sense from a tax perspective. However, I don't know your personal situation, but from what I read here, I don't think that that makes sense. And you said invest in individual ETFs. So yeah, you can buy. So I think people are confused. When you open like an IRA, a 401k, a TFSA, an RRSP, people think that just by putting the money in there, they're doing a great thing. And yes, you are. That is amazing. But you need to invest that money once it's in there. You put the money in there, it's not doing anything. You're still earning pennies on the dollar, right? So what you need to do is you take your money, you put it into a tax sheltered account, and then from there, you choose your investments, okay? You choose what you want to invest in based on your goals, your timeline, and your tolerance to risk. Do you think investing into electric companies are good to invest in, like Tesla? I don't personally try to play the market. So there are two kinds of investing strategies. You can invest passively, or you can actively invest. And when a lot of people think of investing, they're like, yeah, I'm gonna like trade stocks, like those angry guys at the Toronto Stock Exchange or the New York Stock Exchange. I'd be like yelling on my phone, staring at my screens all day. And like, that's not investing. That's trading, and that's basically gambling. Right? You don't want to gamble your money. Do you want to take your retirement savings, go to the casino and throw it all on black? No, I don't, right? I don't want to gamble with my savings, with my retirement savings, with my savings for my goals. Like, I don't want to gamble that. So I'm not going to trade. I'm going to invest. And when I invest, I don't invest in single companies. The reason being is it's super risky. You could lose all of your money, right? When you invest in one thing, if I had $50,000 and I put it all into Air Canada and then they closed, they went bankrupt, and it happens, right guys? Like big companies close all the time. My money is gone. My money is gone. The number one thing that you want to do with your portfolio is make sure that you are diversified, meaning you have a lot of investments in a lot of different places so that you are not overexposed in one area. You know, if you have all of your money, say I put all of my money into oil. I'm like, I'm gonna put all my money into oil, into all these like big oil companies. And then, I don't know, some new government legislation comes out that says we're not gonna be using oil anymore because it's bad for the environment and we're only using electric cars moving forward. You're screwed. You're screwed. You're going to lose all of your money. However, you can buy into what are called ETFs or index funds, which is like a basket of stocks. Okay, you got a basket, you got all your stocks in it, little, you know, hundreds and hundreds and hundreds of different companies, and you own parts of the biggest and best across the world, across multiple industries, across different countries, right? And that is the way that you create a safe portfolio, not by putting all of your eggs in one basket. So when I talk about people trying to beat the market, like the market overall, like stocks will rise and fall. So overall, when we look at you know, the measure of how the stock market overall has done in America, we look at what's called the S&P 500, which is the Standard & Poor's 500 index, okay, which essentially is a list of the 500 biggest and best companies in America, and they're reliable. And we look to them and we're like, hey, you know, how do these companies do? Because we want to know how the stock market's doing. We don't want to look at these like shitty little companies, right? We want to look at the biggest and best and most reliable companies that have been around for a while. Like, how are they doing? And when we look at how they're doing, we can say, okay, you know what? Overall, on average, they go up about 10% a year. So if I invest in all of those 500 companies, and instead of trying to do it individually, like buying stocks from Facebook, buying stocks from Microsoft, whatever, it's super difficult, it's confusing. You can buy a basket of stocks. You can literally buy a basket of stocks that has pieces of all of those 500 companies in it, and that could be a really great place to start, as opposed to trying to beat the market, which is saying, okay, the market overall, the biggest and best companies return 10% on average. But I think I can do better. I think I can outsmart the market. And maybe like Warren Buffett does that, but most day traders lose money. Most hedge fund managers do not beat the market. People that spend all day, every day, researching the market, trying to predict what's going to happen, they're wrong like 94% of the time. So if they can't get it right, we should not be trying to play and time the market. Follow what the market does. 10% a year is an amazing return. Diversify your portfolio and buy an ETF or index fund. It really is that simple. Are there any investment apps that you recommend? I personally use Wealthsimple, but there are also in the States, I know TD Ameritrade is really, really good as well. I personally have heard that, you know, there are some not so great things about Robinhood. So if you guys are in the States and you're like, oh, Robinhood, I know there's all this hype around it right now. My understanding is you can't put tax sheltered accounts in there, which means you're paying money on all of that money that you gain. And there's a few other things too, so something to definitely look out for. I cover all about how to choose the right brokerage in my Millionaire Investor course, so that's something that you guys should check out there as well. Getting back to these questions, I'm looking to save money for retirement and also looking to travel short term. What's best for short-term savings growth? When we're looking at short term, remember when I said we want to have at least 4 to 5 years when we're looking at investing into the markets, because the markets are volatile. Stock prices go up and down hundreds of times a day. It's impossible to time the market, right? So the best way to get ahead with the stock market is to invest over the long term. So what do you do if you don't have a long time horizon? I wouldn't recommend investing your money into the stock market, like I said, if you need it within 4 to 5 years. Because that's when you put yourself in situations where you have to sell and then you lose money, right? When we look at, you know, short term for traveling, a GIC in Canada or a CD in the States, bonds potentially, right? Or just a high yield savings account, so at least you're keeping up with inflation, but you typically don't want to invest money that you're going to need right now. What are some of the best stocks to invest in with good long-term growth? Again, I don't invest in individual stocks. I don't think that they are a good option because you are not diversifying your portfolio, you're trying to beat the market, and typically when people invest in individual stocks it's because they think that that's how you have to invest, and that is just simply wrong, right? You don't have to buy individual stocks. Like I said, you can buy ETFs, index funds that are baskets of stocks, and are a lot safer in my opinion because they are automatically diversified. Any books you recommend for beginner investors? Yes, there are some really, really great ones. The Little Red Book of Common Sense Investing, Unshakable by Tony Robbins, I Will Teach You to Be Rich. Those are some great ones. Rich Dad, Poor Dad, right? You want to understand. I know a lot of people are just coming in and thinking, okay, I just want to know, like, what's the hot stock to buy? And I think, guys, that is the wrong mindset about this. You want to educate yourself as much as possible to be able to, you want to educate yourself as much as possible to be able to understand everything about it, right? And you don't need to understand everything in the sense that, like, we need to know what, like, you know, puts are and, you know, covered calls and all of that kind of stuff, because I think that's just noise, right? Great investors, you don't need to know all of that day trading shit to get ahead with investing. You need to focus on what's important. But to focus on what's important, you need to understand the market. You need to understand diversification. You need to understand what your different options are. And you're only going to get that through educating yourself. So those books are some really great resources. And again, I said, Millionaire Investor that was launched last week. We are on sale with that code Millionaire100 until October 6th. So get in before the prices go up. Okay. I just decided on VU for my first investment. Is enrolling in DRIP a good option? So for everybody watching, VU is Vanguard ETF, which is again a basket of stocks, and it tracks the S&P 500, which is the index that I was talking to you guys about previously. VU is a great choice, right? VU is a great choice. Enrolling in DRIP is always a good option. DRIP is the dividend reinvestment program. So when you invest in companies, you're a part owner, right? You're a part owner of a company. And when you're a part owner of a company and they make money, they share it with you. Now, it's not going to be huge dollars, so don't go thinking that you're going to be able to, you know, sustain your lifestyle on dividends right now. That said, enrolling in DRIP is always a good option. So what that does is when those companies pay you out dividends, which is typically quarterly, so they pay you the money, instead of that money, you know, like a few dollars or whatever it is just coming to you, it reinvests that money for you. And I think that that is always a great, great option. Because that allows you to just buy more and more and more stocks and grow and grow and grow your portfolio without you having to do any work. I am all about making tons of money with the least amount of work possible, right? Because the whole point of it, I'm losing my voice, guys, I'm sorry. The whole point of investing is to get your money working for you. When you're trying to like day trade and stuff, you are still trading hours for dollars because you are spending all day staring at a screen. When you invest the way that I teach, you spend maybe an hour a month, maybe an hour every 6 months, like a couple hours a year. Like you don't need to look at that shit every day. You shouldn't be looking at it every day because that's when you start making emotional decisions that are going to derail your investments. The way that I teach you to invest is to set something up. It basically takes care of itself. You sit back, you come back and look at it in 20 years or whatever it is. Like obviously you need to look at it once in a while to make sure everything's okay. But you sit back and then you just look and you're like, damn, I made a lot of money. Like that is the whole freaking point of this. I don't want you trading more hours for dollars. I want your money working for you. The next question. Everyone has said to me bank stocks, so I should be picking bank stocks. I think that Air Canada has lots of potential because of COVID, so I'm buying a couple of them. Again, ladies, like, I don't buy individual stocks. So if you're looking to outsmart the market, yeah, are there some potentials, you know, are there some possibilities that you could get some above average returns? And when I say above average returns, if the stock market is returning 10%, could you get 15%? Could you get 18%? Yes. Is that sustainable over the long term? Probably not, right? And you have to understand that just because something goes up doesn't mean it's not going to come back down. Look at what's happening with Tesla right now. Okay, so all of those people, you get FOMO, right? You're like, oh damn, Tesla's going up, Apple's going up, this is all going up, 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 up. But what happens, right? You're getting FOMO. People are going in, they're overinflating it. You're speculating. You are assuming that it will go higher. Based on what? Based on the fact that you see it in the news? The news, okay, I'm gonna go on a little bit of a rant here. When you see financial people talking in the news, they are trying to get ratings. They are trying to get eyeballs on their program. They're not trying to like give you the most helpful information. That's not their goal. Their goal is to get as many people to watch as possible so that they can get paid out from advertisers, right? So when you watch them, it's gonna be sensational. One day, I remember one day I looked at my phone and I had like 15 different updates and it was like, the market's gonna crash, it's gonna be worse than the Great Depression. And then the next one was like, nobody's ever gonna see returns as high as this and blah, blah. Every freaking news station had a different spin on the same shit. Guess what? Unless they have a crystal ball, which nobody does, nobody can actually tell you what the hell is going to happen. That is why you need to invest defensively. Stop trying to play the market. Stop trying to pick individual stocks. Okay, stop risking all of your money. Put it in diversified ETFs. Understand what the market does. Understand what your investor profile is. And again, we go through all of this in the Millionaire Investor course. And make the best decision for you based on your goals. Stop listening to all of the noise. Honestly, when you start investing, like you just need to plug your ears. You need to stop listening to all of it because it's going to make you make emotional investing decisions. And I'll talk about this for a second. So I think it was 2018. Was it 2018? When the markets dropped. So in 2018, the markets dropped an average of 4%. Okay, but the average investor lost 9% of their money. Why did the average investor lose 9% when the markets only went down by 4%? Because everybody panic sold. Everyone was like, oh my God, the stocks are dropping, the stocks are dropping. What am I gonna do? I'm losing all my money. Well, if you're diversified, you're not, right? You're not, because if you have a basket of stocks and one of them goes away, you still have the rest of the basket. It doesn't matter that the other one is gone. But when you try to play the market and you buy individual stocks, that's when you put yourself in a precarious position. And the thing is, people do the opposite of what you're supposed to do. We are supposed to buy low and sell high. Buy when it's cheap, sell when it's expensive. But everybody waits and they get FOMO and they're like, shit, I need to buy, shit, I need to buy. Oh my God, I'm gonna buy right now, and then it goes down. So they buy high and they sell low. It is literally the exact opposite. And then they're like, oh my God, the stock market is rigged. You know, you have to be rich to invest because you just lose all your money. It's gambling, blah, blah, blah. It's not. It's not gambling. It is only gambling when you don't know what you're doing and you try to follow the hype, okay? I don't teach any of that shit. I teach defensive investing. So when I say defensive investing, think of it like, you know when you learn how to drive, okay? And you got your driver's license, your driver's permit, and you went in there and they're like, okay, we're gonna teach you how to drive defensively because you can't control what anybody else on the road is doing, but you can control how you react, and that's how we're gonna keep you safe, by controlling how you react. Hello, it's the same thing. It is the same way that we should be investing. We cannot control the markets. We can't control what they're doing, but we can control how we react. So take emotions out of it, okay? Create a diversified portfolio, create a defensive portfolio, and I teach you all of this in my program. And sit back and watch your money grow. That's it. Okay, let's get back to this. That was my little rant. So there you go, guys. I'm planning on purchasing a home before the end of the year. I qualify for $300,000 and have between 5 to 10% for a down payment. My question is, should I put 5 or 10% down? Are interest based on how much money I put down? Asking because if it's not, I would rather put 5% down and invest the other 5%. What are your thoughts? So this is going to be a personal question. I mean, I can't tell you exactly because I don't know what your finances look like personally, but here's what I will say. When you put down less than 20% in most areas, you have to pay either like a mortgage insurance. So in the States, it's PMI. Here in Canada, it is CMHC insurance, okay? And basically what you're doing is the banks are like, hey, you know, you didn't put 20% down. I want to protect myself, so we're going to charge you money to buy insurance to insure your mortgage just in case you don't pay, okay? And it's expensive. Does it make sense in some instances? Yes. In rising housing markets, I 100% believe that you should be getting into the market with 5% down if that means that you're going to be able to get in there and start building some equity. Between 5 to 10%, so I'm not exactly sure. I believe the PMI works the same way in the States, but in Canada, if you have either 5% or 10%, you pay a different amount of mortgage insurance. So that's something to keep in mind as well, because there are going to be costs associated with the difference between 5 and 10% down. You know, whether or not you choose to put 5 or 10%, I think you need to remember that you're also going to have closing costs. I think you also need to remember that buying your first home is very expensive. There are always going to be unexpected expenses that come up. So if you only have that amount of money total, if you have that 10% and you're like, do I put it all in the house or in the house and then the rest, all of it in the stock market? I don't know if either of those are a good idea. I think that you need to make sure first and foremost you have an emergency fund, that you have money put away for expenses on your house. And when we're talking about expenses on a house, people say that you need to have, it's called the 1% rule. So basically you should save 1% of the value of the house to go to repairs and maintenance every year. So you need to make sure that you have some of that put away, right? You need to make sure that you are not putting yourself in a position where you don't have any dollars left, okay? Because we don't know what's going to happen in the economy. And before we start investing, before we start buying real estate, before we do any of that, we need to first and foremost make sure that our personal financial position is good, right? That what we have going on financially is good. Do we have an emergency fund? Do we have, savings? Are we saving for our other goals? What are our debt payments like? Do we have any high interest debt? Have we paid that down? Right? We need to look at the entire picture. And I know, guys, it sounds so sexy to be like, I'm going to get my money working for me, and I don't care about the other financial shit. I don't care about, impulse spending and mindset and whatever. And I understand it doesn't sound sexy. At the same time, that's the stuff that's going to set you up for success and make you successful when you start investing. If you don't have that other shit, you can go and invest right now, but you're going to put yourself in a situation where you could potentially lose your money, because if you need that money, if you put yourself in a position where you have to sell, that's when you can lose all your money. So don't put yourself in that situation. Make sure that you have reserves. So again, should you put 5 or 10% down, you need to weigh all of the costs associated with each one. Look at the whole financial picture. Okay, what is it going to cost you in interest payments on your loan over the life of your loan between 5 and 10%? Do you live in an area where housing prices are increasing? You need to look at the entire picture, and I think people focus so much on the small things And there's a quote that I heard, and it is like my favorite friggin' thing right now. It's, do you want to be sexy or rich? Do you want to be sexy or rich? And a lot of people want to be sexy, right? They're like, yeah, you know, I want to trade stocks and I want to make all this money. And yeah, so do I, man. I want to make a ton of money. But I don't need to be like sexy by doing it. I don't need to know about the hottest new stock. I don't need to know about cryptocurrency. I don't need to know about Forex. Like, I don't need to know any of that bullshit. What I need to know is how to be rich, how to master my money, how to build a system where my money makes money for me, right? I want to be rich. I don't care about the sexy shit on the side, right? I don't care how it sounds to be like, yeah, just put a call in for Tesla. Like, no, I don't care. I don't give a shit, right? Because that's not what is actually going to make me rich. Okay, question. So we have piggy banks for our daughter and they're filling up fast. I'm thinking of investing it for her. Is there a safe way to do this without risking losing everything that's hers? When you invest your money, there is always a possibility that you can lose it all. There's always that possibility. Is it likely if you have done, you know, what I teach, like I said, a diversified portfolio, defensive investing, investing for the long term, that kind of thing? No, it's not probable that you're going to lose your money, and that's why I invest that way, and that's why I teach that method of investing. That said, if you're out there and you're picking individual stocks and you're trying to time the market and you're trying to day trade, could you lose all that money? Sure. When we want to look at, you know, can we invest it for her without losing everything? Number one, yeah, there are investments. Like I said before, GICs in Canada, CDs in the United States, that are guaranteed. That said, because they're guaranteed, they're usually very low levels of interest. Think like 2% if you're lucky, right? You're lucky if they keep up with inflation. So I think first and foremost, I go back to my main questions from before is, you know, what's your goal? What's your timeline? What's your tolerance for risk? What is your goal? So I know you have piggy banks for your daughter and they're filling up fast, but what are you saving that for her for? Is it for education? Is it so that she can buy a house? Is it for, you know, whatever it is? You need to understand what that goal is. I have people coming to me all the time. They're like, I want a lot of money. Okay, but what does that mean? We need to go back to high school with this one, hit those SMART goals, because we need to understand exactly what we're working towards before we can make a winning plan to get there. You know, and the thing is, so if we're looking at, say, I'm going to assume maybe they're saving for her education. I don't know how old your daughter is. Let's say, you know, your daughter's 1. Okay, your daughter's 1, she's going to go to school when she's 18. You have 17 years to save this money. Are you okay putting it into the markets? Are the markets going to go up and down in the short term? Yes, 100%. Could you lose money in the short term? Yes, you will. You will, right? Like the market corrects at least once a year. Since the 1990s, the market has corrected once a year. Okay, meaning it has gone down by 10%. Is that scary? No, it's a great buying opportunity. Everything is on sale. It's all on sale. So you need to look and say, what is my goal? You know, you need to understand more about the markets. You need to understand so that you feel comfortable investing. Because I can tell you all day, you know, the markets have always gone up. But if you don't understand that for yourself, then you're never going to be comfortable. You also need to understand your investor profile. Who are you as an investor? What makes you feel uncomfortable? What makes you comfortable, right? And you want to create a portfolio based on your goals, your timeline, and your tolerance to risk, which is your investor profile. So that is the biggest thing. Okay, one more question, guys. Hi again. I keep seeing index funds and ETFs like VOO, QQQ, VFAX, and I understand by investing in these, you are diversifying. Yes, you are correct. My question is, do I invest a little bit in each one, or is that too diversified, if that even makes sense? In other words, does it make sense to buy a few shares of VOO and a few shares of VEA and another few shares of another one? Or would it make the most sense to find one and invest in that one? So, like I was saying before, typically in your portfolio, you want to have 3 to 6 ETFs or index funds. And again, those want to cover different areas, different industries. So some would be, you know, covering the broad Canadian market, covering the broad US market, like an S&P 500 index fund, like VOO, like you said. You know, covering the Asian market and the European market and whatever it is, right? Because we forget, right, guys, like there are some really, really great big companies outside of Canada, outside of the United States, right? Like, I don't know, Samsung, Toyota, right? Like there are big companies that we should be taking a a part of as well. So you want to diversify, but when you're choosing your investments, this is the problem that I see so many people making, is they're like, okay, I'm going to invest in like this S&P 500 index and then also like this one. But they cover the same company. So you think you're diversified, but you're actually overexposed in a way, because you think you only own 2% of Microsoft, but maybe you own 4. Maybe you own, you know what I mean? Because you're owning both of your funds have similar companies in them. If you're going to pick funds and diversify, you need to pick funds that are very different to give you a broader diversification. It's only diversifying if you have bought into different companies, because if you just buy a bunch of ETFs that are in the same companies, it's not really doing anything for you. So you want to look at, the major holdings for the ETF and the index fund, what their underlying strategy is. Do they all follow the S&P 500? Like, do they all follow tech? You need to make sure that you understand that, so that you can get a better idea of what you can go into. Again, like I said, you want to have 3 to 6 ETFs or index funds typically in your portfolio. But additionally, you can get something called an asset allocated fund, like I said earlier. That is an entire portfolio. It even has bonds in it, right? All in one. And when you create your portfolio, the proportion of stocks versus bonds is going to be dependent on your tolerance for risk, and how old you are, how soon you need that money. Because the sooner you need the money, right? And if you're like older and you're using that for retirement, you're going to need the money sooner. Typically, you want to go into a less risky investment. And you do that by having a smaller proportion of stocks and a higher proportion of bonds. And they have asset allocated ETFs like Vanguard, iShares. They have amazing ones. And like I said, it's an entire portfolio all in one. The management expense ratio, which is how much it costs you to own that investment, is a little bit higher for those, but not astronomical, nothing close to a mutual fund. And it's literally an entire portfolio all in one, and you can just buy one thing, leave it alone, and it rebalances for you and all that kind of stuff. So it is really, really awesome, and I think that is something that a lot of new investors can look into. Additionally, you can look into like robo-advisors. You can also look into financial advisors, but again, I've posted some videos on this, so if you guys are thinking about using a financial advisor, they can be really, really great, but just make sure you understand who you're talking to and watch my videos on them so that you get some more information about kind of what to look out for. So that is it for today, guys. If you have any questions, join the free Facebook group. Again, it is called Master Your Money and Build a Bank Account That Never Stops Growing. So that is on Facebook. I don't know how much longer I'm going to be doing these lives on Instagram for, so head over there, and if you have any questions, you need to post them in the Facebook group to get on here. So get over there, do that. And if you haven't yet, check out The Millionaire Investor. It is a I can't even speak anymore, sorry. It is a 12-module program that will teach you everything you need to know about investing. What we touched on today is just like the tip of the friggin' iceberg, guys. And this course is so freaking amazing. Like, I'm going through it, I'm like, holy shit, man. Like, I'm teaching you everything that you need to know about getting into the market, choosing your investments, picking investments based on your goal. What is your investor profile? Who are you as an investor? What makes the most sense for you personally? I teach you all of it in like super simple terms and super, super easy to follow. And I help you go through, do a deep dive into your finances so you can find more money to invest and really just get your bank account growing for you. So if you guys have any questions, you can send me a DM on Instagram and get in the free Facebook group, and let's friggin' go, ladies. So proud of all of you for joining today and taking control of your financial futures. Bye.